The street will be watching for any similar indications about AI. Tailwinds, inventory normalizations. The shares are up 5% right now. Morgan Stanley also watching its data center business, saying those prospects are compelling from here, while Wells Fargo notes that while MRVL thinks its China business will rebound, there's very little visibility into the timing of that recovery. So given those cross currents, we turn to Ari Wald for our trades today. He's managing director at Oppenheimer. Ari, we don't talk a lot about MRVL, but everyone wants the next NVIDIA now, are they?
Sure. No cross currents here, Kelly. These are all tailwinds, how we see it. We've been on the show since January discussing the semiconductor industry as a top idea and why we think that the bear cycle ended last year. We maintain that view. I think the relative strength of the industry, the broadness of it, and it provides exposure to what we expect to be a rising market tape. So in terms of the broadness, MRVL has really just been the latest to break above its 200-day average, multiple closes above that price level for the first time in over a year. I think that indicates that the stock's prior downtrend has reversed. It still can be considered in its space at $49. That would be the breakout level. But by pullbacks, today's gap is now support at around $46.
All right, forward PE 33. So it's not exactly expensive either. Let's move along to Costco now. It's one of the best performing staples, up about 11% this year. It was a winner in the face of rising inflation, and Stifel says it could also benefit as inflation cools by pushing price cuts that could increase brand loyalty. Stifel, like many, also says Costco is overdue for a membership price hike. The last one was back in 2017. They're typically every 5 years. That said, the recent drop in oil prices could take out a chunk of its sales, and there's the overall spending slowdown to consider. Ari, what do you do with Costco?
Yeah, this is one where we see more mixed evidence. The stock has been in a narrowing range. It's been making both higher lows and lower highs for the better part of the last year. That's fine when the market's in a bear market and it's trading poorly as it was last year. But you really saw this stock's relative strength break in December while the rest of the market was beginning to strengthen. So as it stands right here, right now, we just simply see more attractive opportunities elsewhere while Costco is below resistance at $510.
Better opportunity elsewhere. Okay, let's turn then and see if Ulta is one of those places. Its shares are down about 7% since its last report in March. It blew earnings and comps out of the water in Q4 and issued stronger than expected full guidance, but also said it expects the beauty category to remain healthy, but, to a more moderate typical annual growth rate. Baird, by the way, echoing this in their preview note, they expect a beat given signs of demand resilience, but spending softening. They're watching increasing competition, as well as Ulta's expansion plans of 25 to 30 new stores this year. Is this a buy for you?
This is a buy. This is where we see opportunity, and also rated outperform by Oppenheimer's own Rupesh Parikh, one of the best retail analysts on the street.
Yeah.
The stock's down about 13% from its high, and there's two reasons based on our work while we think this weakness is buyable. First off, stock's coming off a new cycle high in what's been generally a difficult mixed market tape, let's put it that way. So we see that as an indication of relative strength. And this pullback has brought the stock into the bullish slope of its 200-day average, which we define as a near-term opportunity to buy long-term strength. A pullback is an uptrend, if you will. That support level, that 200-day, is at $470. Below there would make us question our view, but with a stop at $470, we see a pullback to be bought in Ulta.
Okay, final question. I'm just going to sneak this in, but it's just about the broader market. We just spoke with Katie Stockton. We're asking everybody about this, the rally that continues in the face of, everything. How do you feel, for instance, about the S&P 500?
It's stuck between a bull and a bear. It's still range bound. I would say more likely to break higher. I see a market from a period of broad-based selling last year. Selling has gotten more concentrated. We're seeing pockets of the market that have started to work. And even thinking about some of these large cap growth stocks that have become near-term overbought, that's not where the issue is. The issue is elsewhere, what's holding it back. On a market pullback, it's the areas of relative weakness, which are the losses that aren't necessarily recouped, that you can buy relative strength on pullback. You buy NVIDIA and semiconductors on pullbacks. So if you're worried about market breadth, I'd be looking at value areas and elsewhere in the market. I think, generally speaking, though, that growth does pull the rest of the market higher.
All right, Ari, thanks. Appreciate your time today.